I kind of feel at this stage, even at this gold price, for the majority, and I won't say for every company, but for a lot of companies, it's actually fairly well supported on fundamental values.
We just think gold just got too expensive. It's been in retrenchment mode. It's back now where it's sort of more or less in line with some of the others. It now looks like it's going to start going up again and joining in with the overall bull market commodities.
We're seeing, again, between both the seniors and the juniors, they're roughly an average across global coverage of about 10% free cash flow yield next year. And yes, indeed, there are some that are considerably higher than that within the mix.
Well, hello and welcome viewers to this precious metals investment discussion for one-to-one mining investment EMEA online. Today, we're focusing on the various investment approaches to gold and precious metals equities and the general attractiveness of the sector and the performance of the mining companies across the various tiers as well. So I have with me a superb panel of long-term investors and analysts within the sector. I'd welcome to the panel John Wong, who's portfolio manager of Ruffer Funds, Sam Catalano, who's mining analyst at Canaccord Genuity, and Ian Williams, who's the CEO of Charteris Treasury portfolio managers. Gentlemen, thanks for taking some time today to give us some feedback and an update on where things are in the precious metals space. Ian, perhaps I could turn to you first, actually. Gold and precious metals seem to have been in a corrective period recently, but looking across the industry, the performance of the gold miners has been really strong. Financially, they've done very well. There's dividends being returned to shareholders. What's your take on this situation that we see at the moment?
Well, gold, I think there's a lot of nonsense, quite frankly, talking about why gold's come down. I mean, gold peaked last July on August and has been in, as you say, retrenchment mode ever since. And if you look back to last July and August, the gold silver ratio was sort of 2,000 year high. The gold oil ratio was the highest it's been. The gold copper ratio was the highest it's been. So gold just got incredibly expensive relative to virtually every other commodity. And since then, you had gold come down, and you had the other commodities have all had sharp rebounds. So that extreme level of overpricing has now been unwound. But the chat in the sort of Bloomberg TVs of this world the gold's been falling because the US Treasury yields are rising. Well, US market didn't start fall, the roof didn't sort of floor didn't fall in on the Treasury market till February this year. And gold has been in retrenchment mode since July of 2020. So we just think gold just got too expensive. It's been in retrenchment mode. It's back now where it's sort of more or less in line with some of the others. It now looks like it's going to start going up again and joining in with the overall bull market commodities. And that's our take on it. So we think the reason the sort of consensus view was that it was all to do with Treasury. We don't think it's anything to do with Treasury.
Right. It's a case of this is quite common in sort of mining cycles. Precious metals move first, and then the rest of the metals tier kind of follow after.
Exactly. Yeah. And gold went up when all the others were going down in March last year. So gold on relative terms got just horrendously expensive relative to all the other commodities.
Yeah, so potentially a good buying opportunity now and then after this correction.
Yeah, especially for silver as well, because silver's got dragged down a bit with gold, and yet it should be getting dragged up with things like copper.
Yeah, definitely. Interesting. Okay, we'll come on to some of those in more detail in a minute. John, could I just bring you in and ask, how have the companies been performing relative to valuations, and how does that play into what's happened around gold at the moment?
So in terms of companies, I guess they also peaked, I think, roughly the same time, I think July, August last year, and they've been selling off in the same vein. They have stabilized. In fact, I think they stabilized actually earlier than gold, in the sense that it stopped falling after a while. And for me, that was a sign that actually a lot of value investors found value in gold, even at that gold price. And so people started to buy the sector a little bit. So I kind of feel at this stage, even at this gold price, for the majority, and I won't say for every company, but for a lot of companies, it's actually fairly well supported on fundamental values. You don't actually need the gold price to go up a lot to make a case for a lot of the equities. Obviously, the higher the gold price goes, they'll be even better. But I think we're kind of in that range right now where actually it's looking quite interesting in terms of valuations.
Yeah, certainly. And do you think that's across the tiers of the companies as well?
They're different. They're different. So the some of the larger, and I don't want to categorically say it's for every company, but on the larger cap generally, they are much more expensive at spot gold. And I would say between the mid and smalls, I would say they're much more value. And it really depends on how much risk you want to take. When I use the word risk, not so much operational risk, maybe a little bit operational risk, but more in terms of liquidity risk and so on and so forth, you want to take going down the market cap. But you can definitely find companies, in the mid-teens free cash flow to even, 20+% free cash flow yields if the gold price just holds. So, I haven't seen a lot of people investing that down there at this stage. And I think that a lot of the generalists who are looking at gold will probably either buy the ETF or buy 2 or 3 of the large caps, like Barrick or Newmont or something like that. So I haven't seen widespread participation on the lower market caps at the moment.
Yeah. So that was going to lead on to my next question about, that generalist capital coming back or what we might need to see. We can touch on that in a bit, but that's interesting because does that indicate to you then that, the price needs to be stabler for longer in order to get that confidence back? Or is it a case that the companies have shown that they've performed very well, but other sectors are still looking quite frothy, other stocks, other global equities, and actually people are still a bit reluctant, generalists are reluctant to sort of plow back into gold miners at this point?
I think with the way generalists look at gold is slightly different in many ways, I think. They do see gold as a diversifier for some. Okay, they think, oh yeah, well, if we want to diversify our portfolio, let's have some gold. For some people, they look at gold as more of a defensive asset. Okay, they kind of think, well, if the whole world is going to hell, economy is disintegrating, gold will probably do reasonably well. And if you kind of put that position, across that position, then you say, well, actually, maybe the world is not in that bad a shape. We've been locked down for a year, but things are starting to open up. The vaccines are working their way through the population. And so maybe economically things might get better. So if you think of it from a generalist point of view, if they're thinking like that, they might be more keen to allocate capital to the more economically sensitive stuff. And less so much for gold, which they don't see as too economically sensitive, if you want to put it like that, because it's more of a defensive asset. So if people feel very bullish about that, then they'll keep buying the copper names, for example, or oil or something like that, or even just general economy, retail, travel, so on and so forth.
Yep. Okay, that's great. Sam, could I turn to you now and get your view on, why maybe some of the stocks had dropped for a period and, valuations have re-rated, and actually we're looking at a really positive period now for mining equities?
Sure. I think, look, I'd echo what John said, to put some numbers from a Canaccord perspective around it. At the moment, on a global basis, the seniors, we see trading at slightly above price to NAV, slightly above 1, whereas your sort of junior producers on the gold side probably closer to still around 0.7, 0.75 NAV. So definitely, as John mentioned, we're also seeing that distinction in valuation. I think, yes, as has been mentioned, the comfort of more generalist investors to invest in the large liquid stocks, it's obviously a little bit of an easier sell. But look, that being said, if we then look at something like free cash flow yield, I mean, again, John mentions, there's some very attractive numbers out there, but broadly, these sorts of gold prices, most of the industry is making a fair bit of cash, even your relatively high cost guys. So, I mean, we're seeing, again, between both the seniors and the juniors, they're roughly an average across global coverage of about 10% free cash flow yield next year. And yes, indeed, there are some that are considerably higher than that within the mix. But what that means, I think, for me, and yes, look, we can go back to the gold price and say, a rising tide will float all boats. And, when gold price goes up, most of the stocks will do well. But I think if we're talking about differentiating that performance, obviously we'll come back to this perhaps a bit later in the discussion, things like reliable operations, operational leverage, the cash generation ability. But for me, the biggest thing that a company can do or a management team can do is how they're thinking about capital allocation. If they're creating all this cash, it's a big question. I guess we throw back to Ian and John, but investors generally, in my experience, are very interested in what they're going to do with it and how they're going to allocate it, and that will really sort out, I think, who could potentially be the winners and losers on a medium to longer term basis.
Yeah, certainly. And so you think overall, with these improved financials, that the sector is undervalued?
Look, I mean, I guess I'd have to say, not some of the larger ones, and I'd say yes, as a broader comment, yeah, small to mid, definitely. As I guess as we see, the recovery in the gold price perhaps continue, or even an improvement in the market's perception of sustainability of current gold prices is probably more to the point, but how we judge that is very difficult. Then you'll start to see people willing to pay, perhaps closer to parity on a NAV basis for some of those smaller stocks. So yes, definitely we would be constructive, positive on stocks, although there is a need to be selective, as there always is.
Yeah, of course. Okay, well let's come to that point then that you raised around, what do shareholders want from the companies now? It seems like the companies have performed well. Maybe the fund flows are not piling back into the sector as yet for various reasons, and we can come to that. But Ian, are you asking of your companies, what are they going to do with this free cash flow? Are you expecting M&A to sort of take off at the end of this year, or is it a case of putting it back into growth?
If you look at the M&A cycle in this industry, you have to say there is a feast and famine cycle. And quite frankly, the last thing a lot of shareholders want to see is the minute these companies start making money, that they start going out spending it all on M&A, because the track record of wasting shareholders' money in cyclical upturns it's a recurring feature. Yeah. And I think a lot of shareholders would be quite happy if they didn't do any M&A, unless they're on the receiving end of a bid from a bigger company. But I think a lot of shareholders would rather have the money paid out in dividends, quite frankly, because they've seen so much money wasted. You go back to the 2011 cycle, not just in the gold and silver space, but in the base metals. All the big miners ended up replacing all their CEOs in 2012, 2013, because it wasted so much money in the paying for overvalued M&A. So I think shareholders would rather not see their companies get involved in M&A and pay out the money in dividends instead, or share buybacks.
Yeah, fair enough. But just to counter that, a good amount of M&A, a healthy amount of M&A is good for the sector, right?
Yeah, as long as they don't overpay for the asset. The history of this industry, they pay ridiculous sums of money at the top of the cycle.
Yeah. Has there been some good M&A sort of last year that you thought, or is it a case of it's too thinly spread?
Yeah, I think that there hasn't, considering how strong the gold market's been over the last 4 or 5 years, I don't think there's been a surprisingly little amount of M&A, actually, because I think a lot of shareholders are sort of reflecting what I just said. if we owned a company and they went out and bought a bargain, absolutely no problem. What we have a problem with is just overpaying a huge premium to overpay for an asset just for the sake of doing some M&A because they're under pressure to do something. So, so we don't mind value-adding transactions, but a lot of them have been value-destroying transactions in the past, and I think that a lot of shareholders don't want to see a repeat of that.
Yeah, absolutely. The resource replacement issue is very real, though, for the sector as well. Do you think that's something, you caught between a rock and a hard place if you're a CEO of one of the major miners, right?
Oh, yeah. I mean, but we don't, that's one of the main reasons we don't buy the big miners, because of exactly that problem. We tend to prefer the mid-space who are going to be on the receiving end of any bids because the big companies have to indulge in resource replacement.
Yep.
I think it's an argument to back up what Sam said, that the mid-caps look cheaper anyway, and it's the mid-caps who aren't going to suffer from resource. They're going to be beneficiaries of resource replacement in a way that the big companies not only are more fully valued, but also are under pressure because of declining production programs.
It's interesting. John, could I get your view on M&A? And, are you really happy with dividends at the moment? Do you share the same sort of view as a holder of these companies?
I think so. The question is actually around capital allocation, and I actually think capital allocation does tell you a lot about a company, and so we do watch the capital allocation really carefully. Personally, I am indifferent in terms of whether it's M&A, whether it's dividends, whether it's buybacks. And I think my caveat is valuation and what you pay for something if you're talking about M&A. And, if you can buy something very cheaply, well, why not, right? If you can invest in organic growth very cheaply, well, why not? And if you can't do either of those, then I think you should give it back. Okay, so for me, I take a pragmatic view on M&A, and it really is on a case-by-case basis for me. I agree with Ian. I know in history there's some really, really bad ones. But I do think that because there were so many poor M&A back in the first gold run, but the gold run in the early 2000s, I think the new CEOs that have been appointed subsequently are actually very gun shy. So I think part of the reason there hasn't been many M&As is because they've seen what happened to their predecessors, okay? And the last thing they want is to get fired for bad M&A. So in a way, that's kind of self-corrected itself. But I think one of the issues for me long-term, when I think of the sector, is something you said, which is replacing of resources, but also just long-term growth. There are very few growth companies in gold because, again, there are just not many organic projects that they can build. And, there are very few companies that can demonstrate a 5 to 10 year growth profile. It just doesn't exist. It's very hard to find something like that because it's a very tough business to grow like that.
Yeah, it's a scalability challenge. Because there's a lot of gold mining companies out there. And I'm sure a lot of companies are knocking on your door at the moment. But filtering through them's, lengthy work. Okay, Sam, do you share the same view around, self-preservation amongst the CEOs at the moment? Is it a case of, dividends are great, but, on the sell side, you certainly want to see some M&A coming through?
Well, look, as an independent research analyst, I'm ambivalent, of course. But absolutely, I think what we've heard here from Ian and John is fairly consistent across a lot of the buy side, and I absolutely agree in that there were some terrible deals, not just in gold, but particularly across the broader resources space. And even from the large diversified miners through precious metals and down, there seems to be a change in attitude. I definitely echo what John said. But But yeah, the proof will be in the pudding, as as the cash balances rack up. How I guess confidently is that used and allocated. And look, I know, I mean, the other guys on the call will be familiar with this, but one thing that gets me very wary when I meet a company is, I don't know how many companies you'll meet where they'll come in and over their presentation say, our aim is to be the next mid-tier gold producer in whatever X region of the world. And I mean, great. Look, that's great aspiration to have, but if you can't show a clear pathway how you're going to do that, then it's just meaningless. And it also makes you think, oh, well, you're just going to suddenly, somehow start splashing the cash around that you're going to make in the short term. So that little phrase always gets me. But I think increasingly we are seeing management teams being more aware and conscious of that and acting very appropriately. They're hearing it day in, day out from their shareholders. So hopefully the message is through.
Yep, certainly. Okay, let's come on to some of the general differentiators that you find within the gold or precious metals equities, for that matter. Talk a bit more about the portfolio approach. Ian, you mentioned before, obviously you've got the mid tiers, but then how far down the scale are you looking at the moment as well? And are there any sort of key differentiators that you would highlight now that are forming your portfolio strategy?
Yeah, well, we've had a slight departure over the last year. We've been venturing into putting small stakes in about 15 or 20 different micro silver miners. We think one or two of them will be 10 or 20 baggers. We just don't know which one. So we're just buying a broad, we've allocated about 15-20% of the fund into junior silver miners. And we think that has a lot of potential upside, but you might have to just be patient. So we've sort of, where we had almost exclusively sort of mid caps, $500 million up to $3 billion, we've been buying a few sort of $100 million market cap companies, but not putting a big amount into any one in particular. We're having just a broad spread, and we just want to have a bit more exposure to that sector. And as such, sort of by default, we've increased the weighting in silver over gold even more. So we're now up to sort of 65-70% silver exposure.
Yep. Is the industrial application of silver showing, is that something you factor in as being a real,
Yeah, I mean, in theory, if copper's outperforming gold for new electrification, then silver should be outperforming gold as well for the same reasons. And then alternatively, if gold's going to outperform copper, silver might even outperform gold as well, just because of its volatility and its beta. So we think silver is probably the most interesting space at the moment, and it hasn't really gone up in line with a lot of these other commodities of late. And we think it should have done, or it should start to do fairly soon.
Yeah, but naturally, with a smaller universe, as you mentioned, you kind of got to be allocated into many companies, because it's not quite.
And we wouldn't feel particularly comfortable putting a big lump of the fund into any one of these companies, because very often you think the one you think is going to be an absolute star turns out to be a dud, and the one you put in just to make the numbers up, that's the one that turns out to be the star. It's very funny it's strange really how this works out sometimes. So for this particular sector, micro cap silver miners, we just prefer sort of have a small toe in quite a few of them in the fund. We think that should work out. Well, one or two are starting to work already, actually, but it's that's what we've been doing anyway. So,
excellent. That's interesting. John, could I turn to you? And has your portfolio approach changed since we last spoke in sort of in the midst of the pandemic, I suppose, last year?
Yeah. So I think the shape has changed a little bit, but not massively. the balance for me is actually it's a liquidity one within the broader fund, and I still need to manage liquidity from the perspective that whether I get drawdowns and so on and so forth. So that's one thing that makes me keep an allocation in some of the larger names. But in terms of tilt, where I find the most value, and that is my style. So I do have a fair amount in the mid and small caps. So that's where I'm positioned. In terms of explorers, which I also do have, but I have a bit less now than I did, say when we spoke, last year.
Yep. And do you think that the appetite for explorers is going to come back when we see sort of the next sort of uptick within the gold sector, or is it a case that there's still just too much risk within that tier at the moment? Maybe Greenfield as well in particular.
Yeah, I think explorers, they are like a talk way to play gold, right? So in a bull market, they do well, and I give them that. But if you didn't think the market was going to move aggressively either way, let's say even flattish, then the explorers is a tough one, because unless they find something big and material where they properly re-rate, they always have to come back to the market for more money, right? It's part of the business model. So that's the negatives with the explorers. But out of all of them, you have some of them that properly re-rate, never come back because they found something very significant that somebody will be prepared to pay like a lot for.
Yeah. But it's increasingly difficult to sort of find that or achieve that as a miner, perhaps. So that's.
I think so, because what is apparent, is that the large caps are looking for very big resources. Right. I think if you can't even show 3 million ounces, I don't think they would even want to think about it. Guys like Barrick are probably looking for 5, something crazy like that. And that's a hard number to achieve, especially if you want to get, decent economics out of that. So that's why it's so hard. And then with the mid and small cap producers, they haven't been buying too many explorers on the M&A, which has surprised me. But that's where I thought that they would be buying to grow. But I haven't seen much of that. So that leaves the explorers in a bit of a tough place.
Yeah, it's interesting. Sam, have you got any views on general differentiators that you advise your investors about in terms of the mining equities?
Of course, there's in terms of differentiate. I mentioned earlier, and we've already discussed capital allocation and how that reflects on management. Yeah. For me, that is a key one. I think the other key ones, of course, is performance and reliability versus guidance. I think one of the most important things a company can do, and I'm not just talking about production guidance or capital guidance, but it's doing what you say you're going to do effectively. Because I think, I spent a couple of years on the bar side myself, and I know that the thing that annoyed me the most or worried me the most was waking up to a company that had done something totally in contrast to anything that had been discussed previously. And that's just not a headache that investors really want. So for me, you'll see a lot of this is coming back to the management team and how they perform, because look, things like, the cost, the AISC of your operations, of course, they can go up and down, and incremental improvement is great, but, they're more slow burn type issues and usually quite well known. It's more about the decisions that management make. I think that the key differentiators in the nearer term. Of course, the other thing we haven't mentioned yet on this call is ESG. It's clearly become a pretty important beast in the overall makeup of the investment sector. I think, if I could just push forward on that, again, you differentiate between how the small and the large cap miners, and within that small and large cap gold companies, the effort they've been able to to dedicate towards ESG efforts. Obviously, if you're a small company, it's just having the resources to, go and make sure that all your policies are aligned with the UN Sustainable Development Goals, for example, or whatever framework that you're trying to align yourself with. So it's a matter of, so there is a bit of differentiation there between small and big. But then also you go to the next step where I think, particularly on the E side, and you have a lot of smaller companies, they've been able to talk about sort of qualitatively that their goals are aligned, but taking the next step and translating that into action and actual change is much more difficult, particularly when you're a smaller firm. Because, for example, if you're a big firm with multiple assets, they're putting in a solar plant and one of those assets isn't probably going to change your bottom line that year. But if you're a single asset company, it's going to make a huge impact and potential disruption. So making those changes is sometimes difficult. I think, though, for me, I'm interested in the other guys' views on this. Amongst small cap, precious metal, but probably across the mining space, the G in ESG is probably an area that perhaps needs more attention. Arguably, there's a lot of investors who would like to see boards and exec management, particularly in pre-production companies, perhaps remunerated a little bit differently with more long-term incentives and less upfront cash, particularly when you're not generating cash. Perhaps that's an area that might be looked to be focused on as the G maybe gets a bit more attention in addition to the E and the S.
Yeah, certainly. I was going to come on to ESG as a sort of differentiator. Do you also see it sort of like bifurcating the market in terms of an investable company and a non-investable company, not just on the tiers of the earlier stage smaller companies versus the producers as such, more those who are doing it well, those who are not doing it well?
In a way, I mean, it's a tough one in this space because if we're talking about attracting generalist investors to junior pre-production miners, I think they could have the best ESG in the world. It's not going to make that much of a difference. Right. But that being said, increasingly, you're seeing the specialists having to ensure that box is ticked. Sometimes it's just a box ticking exercise, but sometimes actually usually also points to better returns and a better run company. And so, yes, I think you need to see it happen sort of to get in the door sometimes these days. If it's bad, you're not getting those meetings. So really it's becoming a prerequisite rather than just a differentiator, if that makes sense.
Yeah, absolutely. Ian, how are you seeing the companies delivering ESG, and is there a particular element within that you'd want to see more of, or do you think it's a case that?
No, I think they're all on top of it. I mean, every time you meet the CEO of these, or any one of these mining companies, they all have their well-polished sort of ESG part of the presentation. And they probably put quite a lot of effort and PR and whatever into producing it. Sam said it's a box they have to tick now. So they're, from what I can see, they're just going out to make sure they tick the box, because otherwise they run the risk that investors won't buy shares in their company.
Yeah, but you think the governance side of things is the big factor that companies are maybe struggling with, maybe the juniors, or do you see?
I think Sam's point is great. I mean, it's a lot easier for a big company to do all this stuff than a small. Yes, and it's and also the social side of it is a lot of these miners don't get the credit for paying for local schools and all sorts of things that they put into the community that they never seem to get the credit for. So they're quick enough to sort of howl in indignation if any sort of water gets spoiled and supply gets damaged around there. But a lot of the miners in Latin America do an awful lot for the local communities as well. I don't think they ever seem to get the full credit for them.
Yeah. Of course, mining, since it's been around, has done a lot for the social aspects of it, and often that goes maybe unheard or unrecognized at the expense of certain other issues for an managing business.
Yeah, they do a lot more than a lot of other industries as well. There's a lot of where these mines are based is all community, and they're very often in these sort of Mexican villages and stuff. The mine is the virtually the sole employer, or certainly the largest employer. And they, as I say, they end up paying for school sometimes and all sorts of stuff. So on that regard of ESG, they actually score very high.
Yeah. It's interesting. John, do you see ESG as sort of like keeping capital away from the sector, or is it more a case of it's splitting the companies in terms of those who are doing it well, or is it more an area that's been pretty much improved?
I think it's more keeping capital away. I don't think it would be a differentiator in any big way, because there are limits to what you can do on ESG. ESG is a cost, right? So if you go crazy on ESG and start to build a whole city for the village next to you, the amount of money you spent on that, your P&L is going to go down the toilet. So, it's a trade-off. And I think you have to do it well these days. Otherwise, you won't get the social license to operate. So I 100% endorse it. But I don't know if you would get a premium rating if you have some kind of premium rating in ESG, unless, I'm not sure what that'll be. But I think my bugbear in ESG is probably more the G, actually, and also around incentivization of pay for management is probably my biggest bugbear.
Yeah. Okay. So the disparity in sort of management level, is that across the tiers as well? Or is that just something that the juniors, the non-producing companies?
I think it's more case by case. I don't know if it's just across the board. I think they're just different. Some of them have good incentivization to align with shareholders, and others maybe a bit more obscure in terms of how they set the incentives, I suppose.
Yeah. Okay, that's great. We're nearly at time. I just wanted to quickly get your views on other precious metals, platinum companies, for instance. Are the industrial applications of those metals, as well as the precious, the value of them as precious metals, are those making them more interesting again, or do they hold a place in your portfolios, or is it a case that it doesn't really show enough upside? So I have a view on that.
Platinum, I think, platinum, palladium, they're more economic sensitive, just like silver. So I think there is a place for it. If you find the right value companies, I think that's a good way to do it. Otherwise, I suppose, you could take a direct exposure and say a platinum ETF or something like that. So I think there is a place for it, but really it's a function of how you view the economy and whether you think that we are, recovering very quickly, the autos demand will go up and so on and so forth. So it's a case by case.
Ian, you don't hold any of the PGMs companies?
No, I mean, we don't buy platinum miners because most of those seem to be domiciled in South Africa. So we tend to steer clear of South African domiciled mining companies. Palladium, there were 1 or 2 stocks. We used to hold one, but that got taken over or it went private. So we haven't really got too much exposure to palladium either. But we have got large exposure to silver. So of all the sort of semi-industrial ones, the other problem. So I'm not would claim to be the world's greatest expert, but if you move to electric cars, how long is the demand for these palladium and platinum to go into these catalytic converters? Because electric cars don't need catalytic converters. So I'm not sure whether long term, if we do going to make this shift towards electric cars, and whether the demand for palladium and platinum isn't going to die away a bit.
Yeah, it's certainly a risk that's apparent for switching from ICUs to electric. I was doing a discussion with someone on hydrogen the other day, and hydrogen's got a strong demand case for for PGMs though in this sort of electrification process. So beyond electric vehicles, if we got to hydrogen vehicles in 2030s, there might be that demand might be balanced out. But who knows? That we're looking a long way off it. Anyway, that's brought us full circle, and it's been great to chat with you gentlemen about the state of play at the moment and what's going on within the precious metals and precious metals equities space. So just thank you very much for your time, and hopefully we'll catch up again not too far away about the state of the market in the future.
Okay. All right.
Thank you.
Cheers.
Thank you.